Good morning to everybody. Happy New Year, firstly. Welcome to the Chamber's first webinar of 2026. Again, apologies for the technical issues. This is a new platform that we are using, so a bit of a couple of teething problems. But this morning we have the pleasure of hearing from Philip Shaw, who is the Chief Economist from Investec in the UK. Just in terms of some housekeeping, we are going to let Philip get on with his presentation, so we'll have Q&A at the end. But if there is a question that you think of during Philip's presentation that you think you may forget about, please just pop it in the chat. We'll look at all the questions in the chat at the end, and we'll also have time for live Q&A, but please just raise your hand. We will also be circulating the slides, so the slides will be circulated probably later today. So don't worry about not getting the slides. But before I hand over to Philip, let me just give you a bit of background. I've already mentioned that he's the Chief Economist for Investec in London, and he's responsible for group economic analysis and forecasts. And he has an economics degree from Bath University and a master's degree in econometrics from the University of Manchester. And he's often quoted in the press, whether on TV or in print, locally and nationally. And Philip, we look forward to hearing from you.
Thanks very much, Dennis. Happy New Year, everybody. Again, an apology from me as well for the technical problems. I'm Chief Economist, as Dennis said, at Investec. I've actually been at Investec in London for 28 years now, which is quite a while. And just a bit of context, the youngest member of my team in London wasn't even born when I joined Investec, which is a bit of a frightening stat, really. But without further ado, I will share my slides. So hopefully you'll get to see them very shortly. Right. Okay. So title of the presentation is the UK economy in 2026, stability or chaos. And I'm just going to give you a very general run through UK economy, what our views are, politics as well, and markets. And actually, I've got a couple of bullets on SA as well. I'm not an SA expert, but thought a few observations might come in useful. Okay, let me try and move the slides forward. Here we go. What you should see here is a slide with two charts of GDP in the UK. There's been a very negative narrative in the press on what the economy's done over the past year. A lot of people say, oh, we're in recession. Well, we're not in recession. I think the way we'd characterize that is, look, it did okay again last year.
Hold tight, sorry, Philip. Sure. People are saying they haven't got sound. I just want to, you can unmute yourselves, anybody, if I've given you options. Does everybody hear it?
Oh. I hear it.
Yes, I can.
Okay, yeah, great. Sorry about that. Carry on.
Sure. Right, two charts here show you UK GDP, i.e. growth, annual growth and quarterly growth in the economy. The bottom chart's annual growth. Just for a bit of context, what you can see there, you can see the big COVID contraction and recoveries in 2020 and then 21, 22. And then we're going back to much more muted movements in the economy. So what we thought that we haven't got the full data yet, but the economy probably grew by about 1.4%, we think, in 2025. You know, consensus expectations through the year have been about 1%. So actually, it's outperformed. This time last year, we were very concerned about which tariffs Trump would impose on, indeed, both the world and the UK specifically. But you know, from what we can see, at least at the macro level, tariffs haven't had a big impact on growth. Now, if you look at the top chart with the teal bars, you can see from the start of 2025, Q1 did very well, moderately in Q2, and then seemed to lose a little bit of momentum through the course of last year. And there may be a couple of reasons why that happened. I think number one, we had a very long lead time between the announcement of the budget and the budget itself in November, with lots of speculation about massive tax increases, and that, you know, from when I talk to my clients, hasn't really helped sentiment, unsurprisingly. The specific event was a cyber attack on Jaguar Land Rover in September, which not only downed output within JLR, but within feeder industries as well. And I suspect also, you know, theme of the day, or one of them, is don't trust all the data. I think there are a couple of seasonal issues with it. You can see at the left-hand side of the top chart, GDP growth was very punchy in the first half of 2024 and then lost momentum. The same thing really happened last year, so it may well be that it's really exaggerating any loss of momentum in economic growth. What we've got is anecdotal evidence. For example, we have a set of surveys, which I know South Africa has them as well, called the Purchasing Managers Indices, PMIs. They're probably the best surveys that we have for the economy as a whole. They're really pointing to modest economic growth at the moment. And you can see from the right-hand side of the top chart, these are our quarterly forecasts. And if you combine those together into annual numbers, then our forecast for this year, i.e. 2026, is 1.3%. That's pretty similar to 2025. And we think, you know, an upside risk is if the government actually begins to facilitate greater house building, which is one of its key pledges. That would certainly help. But if you want longer term growth to be stronger than 1.5%, what's really necessary, and I'll just make the point and then move on, is that the UK economy needs to enjoy greater productivity growth. And that's a key challenge, again, for the government. Okay, the next chart is probably the chart we use most actually in client presentations. It's a chart of CPI inflation. I'll just explain it to you in 30 seconds. The yellow line is the headline rate of CPI inflation. You may be able to see that the current rate is 3.2% in November. The Bank of England's target is 2%. And you can see a massive increase in inflation through 2022 and then a decline. The bars represent the main categories in inflation and the contribution towards the overall inflation rate. So specifically, you can see from the key, it's energy, services, food, and alcohol and tobacco, and then goods. And you can see the aqua bars there in 2022, showing you the massive increases in energy prices, which had a dramatic effect on inflation at that period. Now, more recently, what we've had is a decline, and then what we call a little mini hump in inflation through 2025. And inflation got up to 3.8% in the third quarter, each of the 3 months actually of last year. And that was generally, it wasn't another energy price surge. There were specific reasons why. As you may know, the government introduced VAT on private school fees in January. There was something like, I think it was a 25% or more increase in water charges in April. Food price inflation began to rise again temporarily. And you know, what we had before in previous years was a fall in energy price inflation. Well, energy prices stopped falling, and therefore that puts some upward pressure on the overall rate, if that makes sense. And looking towards the forecast, obviously that's on the right hand side of the chart, we think there are disinflationary factors ahead. And number one, those administered price increases I talked about, namely VAT on private schools and water charges, will fall out of the calculation. That's not to say that those factors aren't there anymore, but in terms of the year-on-year change, they will be more or less zero, and that will push the inflation rate down. And another factor which should help inflation coming down is the fact that the trade wars or at least Trump's tariffs have encouraged the Chinese to export outside America and export disinflation to the rest of the world, and that's a factor also that we've built into our forecast. So we think by the end of this year we're not going to be quite at the Bank of England's target, but not far away. Now, what's more important for inflation over the longer term, and as the Chambers of Commerce, you'll know this better than I do, are what happens to pay growth and labour market dynamics in general. And we think that the labour market is weakening, and that also encourages lower inflation through the longer term. So the chart here, pretty simple chart. It shows the unemployment rate, which is the aqua line, and unfilled vacancies as well. But the vacancies line is inverted, so a rise in that black line actually shows a fall in vacancies. And the current unemployment rate is 5.1%. And if you just ignore the COVID period, that's actually at something fairly close to a 10-year high. Certainly, since the post-pandemic period, job openings have fallen back. We had a very tight labour market just post-COVID, and it's been loosening. And the current vacancy rate is something fairly close to 750,000. Broadly speaking, we've seen some signs of flattening out in recent months, but really at their lowest level since early 2015. If you look at other separate metrics from the labour market, the employment trends, if you look at the data, are pretty unclear. The primary official measure of jobs growth comes from the labour force survey, and that shows employment rising by close to 450,000 over the year to October. We think those figures are very unreliable. They've had really bad technical difficulties with producing the data. So what we tend to do is do a cross-check on other sources of information, and there are some other government measures of employment as well. And two of those, number one from HMRC, and number two, there's a separate workforce jobs survey which measures employment slightly differently. They actually show the number of jobs falling over the past year. So there's a huge divergence there between the various measures. And that's just one of the unreliability issues we have with the data from the Official Bureau, the Office for National Statistics. So we then dig into private sector surveys as well. Obviously, we look at anecdotal evidence. It'd be interesting to hear what you're seeing, those of you that are based in the UK. But the labour market is loosening. The jobs market, we think, is becoming more difficult for employees. Now, one knock-on effect of that is that pay growth is easing back. So the level of pay is rising, but growth is falling back. And that had been a big inflationary problem in 2022, 2023. Starting off with the official number, that's the thicker aqua line there. What the Bank of England likes to look at is not just total earnings growth. They look at the private sector and they strip out distortionary effect from bonuses, and that's what we call private sector regular pay growth. And that's moderated from a rate of over 8% 2.5 years ago to just under 4% now. And that's actually the lowest pace of wage growth since late 2020. Again, so ONS data, you have to check the reliability. We've done a cross-check here with a couple of other series. One is from the Bank of England. It's what they call the decision maker panel, the realised wage growth series. That's the black line there. And there's an internet job vacancies company called Indeed. They do a wage tracker, that's the grey line, and they're at different levels, but you can see the general trend is that pay growth is falling. And importantly, what we also do is that we look at forecasts and predictions of where pay deals are going to be at the end of the year, and a separate survey from the Bank of England and from a company that's been going for decades, actually called Brightmine in various shapes or forms, are saying essentially that pay growth over 2026 are going to be about 3 to 3.5%. So that's way above the 8% that we saw in 2023, and something which is more consistent with achieving the inflation target of 2% over the medium term. So if you're the Bank of England, what you're going to think is, look, pay growth is just a little bit high at the moment, but it's likely to fall back. So with that in mind, let's have a couple of slides where we talk about interest rates. Excuse me, I'm just going to cough briefly. Okay, so a very recent history of interest rates. The Monetary Policy Committee of the Bank of England began to raise rates from near zero in December 2021, and they reached a peak of 5.25% in August of 2023. That's the UK bank rate, as it's technically known. And then a year later, the MPC thought, okay, inflation dangers are not as great. We'll start to ease monetary policy, i.e. bring interest rates down. Last year, we saw 4 rate reductions of each of 1/4%. As you may know, the current level of the bank rate is 3.75%. And if you listen to MPC members and read the Bank of England stuff, the guidance is that over most of last year, the committee took a very gradual and careful approach to lowering interest rates. And that's because despite the better inflation metrics, the members saw that there were still upside inflation risks in the medium term. Now, another factor is that as rates come down, you are approaching a point where the level of rates neither stimulates the economy nor slows it down. And in conceptual terms, that's called the neutral level of rates. That is likely to make the MPC even more cautious, we think, in lowering rates, particularly when inflation at the moment is still somewhere above the inflation target. We don't know where the level of neutral rates is. The MPC certainly can't agree on that. Our suspicion is it's close to 3%. The other point I think on interest rates and the dynamics of the MPC is that the committee is really, really divided. We have 8 MPC meetings a year, and there's been no unanimity on the committee on just straight interest rate decisions since September 2021. There's been at least one dissenting voice in every meeting. And actually in December, the decision to cut interest rates from 4 to 3.75, the vote was 5-4. If you go to November, the votes to keep interest rates on hold was 5-4. And turned out, as we suspected it would do, it was the Governor Andrew Bailey who changed his mind. He was the swing voter on the committee. So, one general tip is listen to what Bailey says on interest rates, not just because he's the governor, but because in practice at the moment he tends to be the swing or the deciding voter. So the outlook for rates, look, it's going to be very data dependent. It depends on a whole load of the things that I've talked about so far. But I think the general feeling on the committee is that it's likely to be a little bit more fearful about upside risks to inflation, and that perhaps that the disinflation process stalls if it brings rates down too promptly. So what does that mean in terms of our forecasts? Well, chart here, pretty simple chart. It's the level of the bank rate in black on the left hand side. Our forecasts are on the right hand side there of that chart. And what's priced into financial markets are the dotted lines. The aqua line is what's priced into what we call the yield curve now, and a month ago is the slightly purple line. So we're of the opinion that having cut rates in December, the MPC is going to keep rates on hold for a while, but we do think that direction is still down, but as I mentioned, more slowly than last year. We actually think we're going to get a cut. There's an announcement on the 30th of April. So I think we get down to 3.5% then, and 3.25% on the 30th of July. So and then on hold for the rest of the year. We suspect therefore that the level of the bank rate will be 3.25% at end 2026. For 2027. We've penciled in one further move to 3%, which happens to accord with our version of interest rate neutrality, but clearly there are some big question marks, particularly over next year. What are markets pricing in? They're not quite convinced of our view that we get down to 3.25%. You can see that by where the aqua line is compared to our black line at the end of that horizon, but fairly close to it, and more convinced than they were a month ago because that dashed line is lower. than it was at the beginning of December. So in short, rates continue coming down, but more slowly, with the MPC being even more cautious this year. Right, politics. Fascinating subject, as I'm sure those of you that are in the UK will testify. And what we have is politics determining the policy agenda more than usual. I managed to annoy my Labour Party member friends after the election in July 2024 when I said, yeah, you've got a very fragile majority of 172. So, I mean, that is a large majority. But the point was that I said, I think it's pretty flaky, given that Labour won, I think it was under 35% of the vote. Its working majority is now technically 167 in the Commons, still pretty large, but look at the opinion polls. They are really struggling. And so the chart here just shows you voting intentions since the beginning of 2024. You can see pretty clearly that the leaders are Reform UK. Now, this chart, the standings in the opinion polls depends on which polls you include and you exclude. On this basis, Labour are actually fourth, with the Conservatives having regained second place, the Greens in third. I think that might slightly understate Labour's vote. That's my personal view, but we use this chart fairly frequently. If you look at election dynamics, Reform have won one Westminster by-election from Labour up in Runcorn in the northwest. They've actually now got control of 10 local authorities, county councils. So all eyes on what's going on there. Now, again, those of you based in Britain will know that we have a constituency-based electoral system, 650 seats. The winner in each seat gets an MP. We don't have a PR system as you do or SA does. There's a new, so it's very difficult when you get big shifts in political dynamics to translate votes into seats if you're trying to predict it. And in short, I can talk about this in a bit more detail if you like afterwards, but there is a polling technique which is about 9 years old called MRP, and that effectively tries to predict seat by seat winners based on voting characteristics. And YouGov, which is one of the biggest polling companies, published an MRP poll a few weeks ago that suggests if there were an election now on current poll ratings, Reform would get 381 seats, which would give them an overall majority in the Commons of about 120, with Labour down to 85 seats from over 400 now. So the polls are really, really important in terms of the political future, but you can also see why Labour is being more populist. We had a U-turn on ID cards overnight. I think that's the 13th government U-turn since it came to power. But you can see, what it's worried about. You can see what MPs are worried about as well. One further question is, will Reform swallow up the Conservatives as they did in Canada after a disastrous election for the Canadian Tories in 1993? And that's a question that we're trying to work out, and I'm sure the Conservatives are as well. So that's a current poll standings. I'll just make a couple of other points on politics. We've got May local elections, and there are also elections to the Scottish Assembly and the Welsh Senate. If those polls don't turn around soon, Starmer's going to be under real pressure to resign. It's very difficult to get rid of a Labour leader. The Labour Party tends not to throw its leaders out. What tends to happen is that they tend to fall on their sword more. Now, if that happens to Starmer, the key question is now who's going to take over and what's the shape of the government going to look like? Now, the favourite would be Wes Streeting, who's a centrist. He's the current health secretary. Other people in the fray, Angela Rayner, who's the former Deputy Prime Minister in the so-called soft left of the Labour Party, Andy Burnham, who's not currently an MP, but he's the former Health Secretary and current Mayor of Greater Manchester, also these days on the soft left. Now, markets, if they begin to sense that Starmer's going to go, will begin to worry well ahead of any resignation and leadership elections, we would expect at least a modest sell-off in sterling and possibly the gilt market as well. What's the reason for that? Well, investors would be worried about the left of the Labour Party taking power. That partly reflects markets' view of how competent they are, but also more specifically the commitment to fiscal stability. And I'll talk about fiscal policy in a second. If Starmer goes, Rees will probably go, and so will the fiscal rules go. And markets will be saying, we don't know whether Streeting will be in power or Rayner or Burnham. What's the fiscal outlook going to be like? So we expect some nerves if that happens. They'd be temporary if Streeting wins, and it would be more or less, I think, business as normal. And of course, it's possible that Starmer survives all this. It's not impossible. But we're keeping a really close eye on the polls. Got to say, there was a YouGov poll the other day which showed the Labour Party 4% behind. That would be a massive recovery. I'm not sure how much faith to put in that. If you look at Reform's policies, they are completely populist. And remember, Reform UK are the latest incarnation of Nigel Farage's Brexit party. The party realises that if it's going to be taken seriously, it's going to have to come up with a more realistic platform. It can't, for example, say, oh, we're going to raise the personal allowance, income tax allowance from around £13,000 to £20,000 a year. They simply will not have the money to do that. So let's see what the platform is. If it becomes more realistic, they will probably lose votes. But watch the polls. I mentioned politics, and I've mentioned fiscal policy. So let's talk about fiscal policy a little bit more here. The chart here looks at the total UK deficit. It's a cumulative deficit over each financial year. So if you start off in month 1 and by month 12, that's March of the financial year, that's the total deficit. And the black line is the financial year so far. You can see that, again, so far this year, the deficit's running at a greater pace than the previous 3 years. And it's also running above the Office for Budget Responsibility's Fiscal Watchdog's forecast. The forecasts are from March, and they're not from the recent budget. But it's just to show you we've had bad fiscal news. It's a poor fiscal position. In 2024-25, the deficit was over £150 billion. That's over 5% of GDP, which is large. If you look at the level of cumulative public sector debt, that's not far off £3 trillion. That's 96% of GDP. And you can see a clear case for consolidation. Now, as I've said, so far this year, the news hasn't been good. We actually think that those numbers will improve over the remainder of the fiscal year, partly because there were big increases in spending in the previous year at that time, which won't be repeated this year. But even so, the level of the deficit does justify, in our view, a continued fiscal consolidation. We do have fiscal rules on both the deficit and debt. I won't go into them in any detail. They're slightly different from the deficit's slightly different from that headline measure, and so is the debt. But the OBR back at the time of the budget in November said, look, okay, the tax increases that we've had mean that you've got headroom against your fiscal rules of 22 billion and 24 billion over the 2 main rules. And these rules are assessed against what the OBR forecasts in the year 2029-30. So it's very much a medium-term approach. Now, we've talked about U-turns. We've had a number of U-turns on welfare. That's put pressure on the deficit, but they are in the fiscal arithmetic now. Higher defence plans, not convinced that's all in the fiscal arithmetic yet. What will the government do about it? More talk about more tax increases. I wouldn't be surprised if you get a centrist outturn, if Starmer survives or if Streeting takes his place, that you actually get some steps to curb the welfare bill in the UK. And if you look at some of the numbers, they're frightening. Strip out old age spending, i.e. pensioner spending, the welfare bill is £172 billion a year, or it's estimated to be this year. But you need the political will to be able to do it, which the government doesn't yet. But if you see Starmer surviving or Streeting taken over, I'd say the focus of the next few years will be on cutting the welfare bill. A left-wing Labour government, certainly less commitment to welfare and fiscal stability in general, which is why we're saying markets could get jittery if Labour doesn't improve its standing in the polls. Is this really important? Well, yes, it is. Whenever I do some business outside the UK, everyone reminds me of Liz Truss. So Liz Truss, if you remember, was the Prime Minister for a grand total of 49 days in 2022. And markets reacted in anticipation of her coming to power because she was making some comments about expansionary fiscal policy, and inflation was very high at that point. And you can see from that chart, you can see the increase in gilt yields from the summer, i.e. June to July, through to when we had a mini budget in late September, which lasted for a while longer until Truss left, the Chancellor Kwarteng left, and the new government stabilised the ship. And what you also saw was a big fall in sterling as well, and that's the bottom chart there. Actually, intraday, sterling reached 103. I think it's 103.30 against the US dollar, which is an all-time low. So fiscal policy does matter. Metrics do matter. What we've seen is international bond markets sometimes getting very jittery about what's happening in the States and the fiscal situation there. So it's really longer term borrowing costs that investors are becoming more concerned about. And again, that ties into what I'm saying about the UK. One point is that if you look at the level of gilt yields, they're actually higher now. I think 10-year gilt yields are currently about 4.40 and over 5% for 30-year yields. But it's really that speed of increase which is really important. Okay, talk about the pound for a little bit. How much time have we got left? Okay, I'll speed up a little bit. What we had through the course of last year, this is sterling against the US dollar in black and sterling against the euro in orange, and higher level of the line means higher, stronger sterling. We had a gain in sterling against the US dollar last year, but that was mainly due to a weaker dollar. The pound did lose ground against a generally stronger euro, and the euro was helped by the thought of fiscal policy being loosened to pay for more defence and infrastructure spending. Oh, excuse me. Okay. Bigger picture this year, we think, is that the US dollar loses a little bit of ground, but you know, Donald Trump's in charge. We don't know what he's going to do geopolitically. His tariffs are under threat. There's a lot of uncertainty there, but that's our view. And we think by the end of the year, we see sterling at about 135 against the US dollar and 89p against the euro, but with some jitters in between, as I have argued. I'm not an SA expert, but I thought I would include a couple of points on SA, just because I think it's very interesting from someone who does look at SA from a very interested bystander. I've just seen a much more positive narrative from particular international investors and when I was there in the middle of last year. And why is that the case? Well, certainly the rally in gold and other metals have helped. We think that that's really going to help the South African public finances, and we note that SA has local elections at the end of the year, which could give the government a little bit more room to open the spending taps. And as I said, international investor sentiment has just completely turned, and you just have to look at the performance of JSE to show you that. In terms of economic fundamentals, you've had lower inflation. Inflation is currently 3.5%, and the SAR's been lowering rates. You had 4 cuts in rates last year with the current repo rate at 6.75. There is a new CPI target at 3%, and the SARB is likely to be a little bit more cautious. It's a similar narrative to the UK, I guess, just to make sure that that is in sight over the medium term. But our team in Johannesburg is suggesting 2 more rate reductions this year, and the economy to grow modestly, 1.5–2% over the next year or two. And when I talk to people, they're suggesting that Operation Vulindlela is really lending some upside to the economy there, getting it from corporates as well to a certain extent. And in terms of the rand, we know it's a very volatile currency, but just for the record, we're looking at 16.75 against the US dollar and perhaps 22.5 against sterling end of this year. Right, I think I've almost spoken for too long, so I'll just make some closing points. Back to the UK growth story, it did okay. But if you want stronger numbers, you need more house building, you need better productivity growth. We think that the disinflation narrative is intact this year, which should allow the MPC to cut rates. But as I've said, probably 2 rather than 4 cuts this year. Politics really doesn't look good for the government, and the pressure on Starmer and therefore Rachel Reeves will really get worse unless those poll ratings begin to turn. Don't know how likely that is. As I said, just watch that market pressure ahead of the local elections in May. But it's possible that you get a market-friendly government, even if there is a leadership election. Reform support, when will the party become more realistic? I think it has to. I suspect actually its poll ratings will begin to fall, but how much we don't know. Fiscal situation, there's an alarm clock there as the icon. Wake up. Yes, there is a bit of headroom against the rules, but the government can't afford too many more U-turns. But I have said I suspect there'll be some sort of onslaught on welfare spending. So say sunny outlook for SA, certainly looking more positive. And last point is stability, probably. And if you remember the title of the presentation, it's stability or chaos. We'll think there'll be some jitters, but actually more likely to see stability this year in the UK. Right, that's it from me. Be delighted to get any questions or any comments you might have, and I'll hand over to Dennis.
Just one thing, everybody, the cameras and your microphones you can put on now. So if you want to join, and then there are some people with questions. So do feel to join us after Dennis has given us a few words.
Yeah, thanks, Ben. Philip, thanks very much. Yeah, just your last point about stability, probably. I'm hoping that's right, because it just seems to be a lot on the go at the moment. Just before we open questions to the floor, just one question from myself, and I know it's a difficult question because you probably don't have the answer because it's about Donald Trump. So his new sort of mergers and acquisitions policy, where he just seems to be sucking up all the countries. So we know that there was limited effect on Venezuela, but if something like Greenland and goes ahead, how is that going to impact on Europe and the European economies? Do you think there's going to be major impact on that?
Yeah, I think out of everything that's going on at the moment, and as we know, as you put it very nicely, Dennis, the acquisitions policy include Venezuela, Cuba, Iran more recently. But Greenland, I think, is probably the most radical plan. I think that the feeling is that Trump will not invade Greenland. I think that would be a step too far, even for Trump. Another point I'd make is that the idea of the US acquiring Greenland, which technically at the moment is semi-part of Denmark, that's nothing new. That's been going on since the 19th century. And certainly then it wasn't about defense. It was more about the resources. Even though Greenland is an inhospitable place to try and drill out of the ground. Trump is claiming that, look, it's strategically necessary defence-wise, but of course if it's strategically necessary, you can agree to put defence stations on the place. You don't have to buy it, or certainly not to invade it. I suspect though that a lot of it is to do with resources there. There is a meeting between the Greenlanders, the Danes, and I think JD Vance is going along as well. I think this is going to be an evolving picture. From what I can see in terms of the Greenlanders themselves, I can't remember what the population of Greenland is. I think it's about 70,000. It's really not huge.
56,000.
Is it that few? Okay.
Yeah. As a Dane, I can say that.
Right. Okay.
Actually, 57,000. Sorry. Yeah.
So, yeah, I think the feeling within Greenland is that they would rather be associated with Denmark. You know, where things go from there, I don't know. Another something I haven't talked about is the political situation in the US actually, and where that's relevant here is that at the moment, if you look at the poll ratings, Trump, or at least the Republicans, are on course to lose the House of Representatives in the midterm elections. They'll probably hold on to the Senate, but not the House, which means that it makes life a lot more difficult for him to govern, and he can only govern by executive order to a certain extent, as he's beginning to work out with the tariff policy as well. So yeah, I mean, you're absolutely right, Dennis. I do not have the answer to that one, but I suspect that it's going to be a matter of negotiation. And I think the last thing I'll say on this is the precedent. This time last year, we were, as I mentioned, really trying to work out what Trump would do on tariffs, and our view was, look, he is going to put tariffs on. They're not going to be stuck. He will try and get negotiations going with various countries, not just for trade policy, but for geopolitical reasons as well. And a lot of people were saying, no, he's not going to negotiate. And I think it's much the same with Greenland. He sets out his stall, but he's going to negotiate. And this is the president that wrote The Art of the Deal, of course.
Okay, thanks, Philip. Mike Miller, did you have a question?
I was just going to make a comment about the Labour Party here, who don't seem to understand unintended consequences. And a lot of their movements, whether it be 20% on a VAT on school fees, the inheritance tax issue, the national insurance issue, where they said they wouldn't raise national insurance, but then did for employers, which of course had an impact on unemployment. So I've actually been having an email exchange with my local MP, Joy Morrissey, who's the MP for Beaconsfield, and I get responses back from the government, but they don't seem to understand. The reason them to do U-turns is they don't understand unintended consequences.
Yeah, I'll respond to that. I'll set out my political affiliations, which are zero. I'm pretty neutral politically, so I feel I can make some frank comments without being accused of being political. I must admit, I thought that the hike in NI employers' contribution woeful. I've been doing this sort of job for a very long time, and I have never had such a backlash from not just clients, but just people in business that I talk to, of how bad or how badly they've been affected by the NI hike. And I certainly agree. Sorry, was it Mike? That they just didn't think that through. I've got to be fair and say I think they inherited a really poor situation from the previous government and had to do something. But surely you should try to explain that to voters in a more rational way, and similarly meet any fiscal requirement with a more rational policy. But having painted themselves into a corner, boxed themselves into a corner, they were unable to take any other significant revenue raising measures. And yeah, Yeah, I have head in hands quite frequently over what the government does, I'm afraid.
Well, one of the things that the government keeps doing is talking about 14 years of Tory misrule. And they lost the election very heavily in 2019 under Corbyn. So at the best they could say 5 years of Tory misrule. And I just get annoyed when there was one this morning with the Transport Secretary doing, well, we inherited this and yes. And admittedly, the interviewer just said, stop, just tell us what you're going to do with the Northern Rail. Yeah. They're so busy and their doom and gloom has resulted in lower productivity, lower, just a feeling of doom and gloom, which is just stupid, absolutely stupid. There's an old saying, Conservatives are the happiest when they're in power, Labour are happiest when they're in opposition and complaining. And Labour councils, I know the Slough Council, I work with SEBMAT, the South East Berkshire, Slough and East Berkshire Multi-Academy Trust, and the Slough Council is bankrupt. And so many Labour councils across the country are bankrupt because I don't know, I just feel that the whole thing is a mess. It really is. And, you know,
Yeah.
as you
I
say, reform, you know, has making all sorts of populist statements. And that's not going to help.
Yeah, I think my passing shot on that would be, yes, you inherited a mess, but please tell us what you are doing to rectify that mess.
Agreed.
Yeah, and in South Africa, they go back 30 years and complain about that. Okay, there's a question from the floor as well that says, does the UK inflation appear transient or indicate more structural issues, you know, i.e. demand or supply side inflation? That's from James.
Yeah, I think it's more transient. Looking at wage growth in the post-COVID period, you could really see that there was an immense tightness in the labour market, with people reluctant to go back to work. But I think that is now changing. Pay growth is down. Another factor was that there was the supply of goods was very much restricted in the post-COVID era, and that pushed inflation up. I think that's gone. As I argued, China is exporting disinflation again now. I think what has changed is that we are in a more volatile environment, and so inflation is likely to be more volatile. So I probably belong more to the transitory school of thought than the permanent school of thought, but I do believe that the Monetary Policy Committee is correct to be more careful about where it sets rates this year.
Thanks, Philip. Jason?
Ben, yeah, I got a question. Thanks, Philip, for the presentation. My question's around foreign direct investment. We're a private equity fund that invests into the UK student living. So more of a general question in terms of investment into the UK, and what is the view on the UK still being a safe haven, given the politics, given the currency fluctuations, given global economics? You know, I'm quite encouraged investors to come into the UK. So what is the view on investment into the UK? And your views around that would be great. And what is UK doing to encourage foreign direct investment?
Yeah, no, very good question, Jason. It wasn't, I think it was 15 months ago that just across the road from our offices in Gresham Street, the government had a big FDI forum at the Guildhall where it said, I think there's going to be over 65 billion of FDI being pledged from this forum. Yeah, do we fully take that on board?
Yeah.
I think we need. The government will probably get the benefit of the doubt unless it makes some real missteps again. I think the increase in NI was a real mistake, as I've said. You know, the Employment Rights Bill, that's been modified so that new employees don't get immediate rights instead of waiting for 2 years, and they've struck a compromise to 6 months, which I hope employers can live with. You've still got fiscal policy is not in a great place, but at least there's an independent watchdog that keeps the government in check on it. You've got an independent central bank. So I mean, those cornerstones, if you like, it's the economic cornerstones of the infrastructure are still there. I think what I would like to see is a move towards more labour flexibility. That's labour market flexibility rather than more rules. That's my own personal point of view. But I'd say that the world is a dangerous place generally. And UK growth's been all right. Our nearest country to London, France, not in a great place at the moment. Parliament is so polarised it can't pass a budget. Germany, powerhouse economy, but really struggling because of its high energy costs and its, dependence on the manufacturing sector. Would we say the US is a safe haven at the moment? No. I think the world has changed. It's not just the UK. So I wouldn't be too gloomy about the UK, but I would be quite keen on sending the government a shopping list of things to do.
So the best or the worst? UK.
Yeah.
Great. Thanks for
worst.
that. Yeah.
Least worst.
Thank you.
Thanks, Jason. There don't seem to be any other questions unless I've missed something. So
good.
Philip, just thank you very much again. Very, very insightful. Again, apologies to everybody for our technical issues that we had at the beginning. Mention again that the slides will be distributed today and the recording will be up on the website probably in the next week. We just need to obviously do some editing. But Philip, thank you. Really appreciate it.
My pleasure.